Okay, pivoting back to gold now. Our next presenter is Mark Zepner, Managing Director of Ramelius Resources. Mark's a mining engineer and was educated at the WA School of Mines here in Kalgoorlie and has more than 30 years' experience, including senior operational and management positions with WMC and Goldfields at their gold and nickel assets in Australia and offshore. He joined Ramelius as Chief Operating Officer in March 2012, took up the reins as CEO in June 2014 and Managing Director in July of 2015. Thanks very much, Mark. Over to you.
Thank you, Duncan, and thank you to Diggers for giving Ramelius another opportunity to present, understanding that it's never been more competitive for spots. It's always great to be back in my hometown. I'd just like to say that I hope the city does address the accommodation shortages, noting the golf course resort has been delayed again until 2024, as I would hate for there to be a push to move the conference because of it. As a gold producer, 2022 so far has been particularly tough, both in the operating environment in WA and the equities market. Despite this, Ramelius remains a strong, cash flow positive business that is well positioned for growth. This qualification is available on our website along with all of our previous presentations. If I may start with the corporate overview, using last Thursday's, and even more so if you use today's share price, our current market cap is well down on the 1.4 billion only back in March. Importantly, we have a healthy cash and gold balance of almost 173 million, and whilst we have access to a relatively new $100 million facility, it is currently undrawn. No changes to key personnel within the company have taken place other than the retirement of long-standing non-exec director Mike Bohm, who finished up in May. This demonstrates excellent stability within the management team in a particularly tough labour market. We produced just under 260,000 ounces at $15.23 an ounce in FY22, and we've guided to similar production, albeit at a higher all-in sustaining cost, which we believe is a one-year phenomenon with our high-grade Penny mine to drive costs lower in FY24 and 25. At Ramelius, we believe in living our mission and values, working on our strategic priorities and bedding down our essentials program. Touching on each one briefly, our mission to deliver superior returns is unchanged through a combination of capital growth, and yield. Our values, we feel, are very apt. We are a can-do company that aims for fit-for-purpose outcomes and who prides themselves on delivering these outcomes safely, all the while remaining credible. We continue to work on brownfields exploration and bolt-on acquisitions to feed our existing hubs, but are strongly focused on the right third hub, which I'll talk about more later. We believe that our Rebecca project is the perfect setting for ramping up greenfields exploration, ultimately setting us up for further growth. The Essentials program is designed to ensure we do the fundamental things well and with consistency. By working on the 7 elements of the pinwheel on the right-hand side of the slide, we're also moving our ESG credentials forward. Our project map is next, where we show our 2 production centres, Mount Magnet and Edna May. The arrows depict trucking of high-grade ores from our satellite operations to complement the generally lower-grade baseload ore located near each mill. We have Vivian to the north, which, despite the distance, has been one of our most profitable ore sources due to its decent grade of around 6 grams per tonne. We also plan to truck the even higher-grade ore from Penny to Mount Magnet once the haul route is fully upgraded. Thus, we have a dotted arrow there. At Edna May, just outside the township of Westonia, we are bringing in the Marda ore from north of Southern Cross and also trucking the Tampia ore past Narrabeen to the south. Our assets are generally located close to major regional centres and haulage routes, and we have well-established processing facilities operating well. It is this continued use of sunk capital that underpins a key part of our growth strategy. Given Ramelius's hub and spoke model, as it's sometimes referred to, we have felt labour shortages, particularly road train drivers, more than most. Prior to the WA border reopening, without access to East Coast labour, this was at its worst. See January and February on the slide. Now, with the border reopening in early March, we went from around 80 to 90,000 tonnes a month to a rate above our FY22 planned average of 120,000 tonnes a month, which is the dotted line. We felt good about this influx of labour and then went and forecast in the region of 140,000 tonnes in Q4, shown in blue. Unfortunately, the COVID-related absenteeism that has impacted many companies resulted in a 2 steps forward, 1 step back result. That is, better than we were, but not as good as we would have liked. In knowing this, we have used this rate as a base and gradually ramped up haulage through our FY23 production plan. These days, it's about maintaining margins rather than margin expansion we saw in previous years. This graph we put up religiously, gold production yellow bars, realised gold price being the green line, all-in sustaining cost the orange line, but now we have the pandemic overlay shown from mid-FY20. We saw an average of 20% year-on-year production increases from the period FY15 to FY21, with very stable costs leading to an expansion in margins over that time, from 20% to around 43% margin over all-in sustaining costs. A slight reduction in the realised gold price in FY22, combined with increased COVID impacts as discussed, has trimmed this margin back to 37%, still healthy and something we're working hard to protect. Our guidance for FY23 is 240 to 280,000 ounces at an all-in sustaining cost of between $1,750 and $1,950 an ounce. This increase in cost is due to a combination of factors, such as wages, diesel and consumables, plus a lesser contribution from high-grade sources such as Shannon and Vivian, and finally some non-cash charges as we run down stockpiles at certain operations. Whilst the high-grade Penny project does mitigate some of this in FY23, it's not until FY24 and 25, when that operation is at almost 100,000 ounces per year run rate, does the group all-in sustaining cost resemble something more akin to this year's numbers. Lastly, our clear strategy is to continue on the production growth path you see here, as we believe that this will result in best returns for shareholders. Now some key project updates. You've got to start with Penny. When we make the claims about high grade, it is on the back of 14 to 15 gram resource and reserve grades. This is largely associated with the Penny North ore body, which you can see here has the magenta colouring which captures the 10 to 20 gram grade range. Now, when we completed the feasibility study back in October 2020, the projected all-in sustaining cost was $633 an ounce. This has been inflated to almost $750 an ounce to represent current costs. It still represents one of the lowest in the gold space, with compelling payback metrics as you would expect. Now, most of the upfront capital has been spent, with only the airstrip and the decline down to the Penny North ore body to complete, leaving less than $7 million to spend. You can see as marked on the section that we're very close to the first ore drive. We recently intersected what we believe is the southern extension of the Penny lode, well south, about 90 metres south of the current resource boundary. A nice, if unexpected, problem to have, and one we will assess once we have a drill rig on site. Not showing here, but we have a plan to drill exploration holes into Penny West itself, which is on the left, and into the gap between the two ore bodies in FY23. And given recent events, we do remain confident of adding high margin ounces at this project. Now, given the last 2 site visits have been cancelled due to rain, I find that it's actually easier to just have a video instead. At Vivian, we're down to the last 2 years, although I have said that before. We have the remaining underground production areas shown in lime to be mined in FY23 and a potential Crown Pillar open pit shown in purple for FY24. Now, Vivian's been a wonderful investment for Ramelius with a plus 10 times return on our original $10 million outlay. This has been possible largely on the back of a more than 150% increase on the original reserve. And what's nice about Vivian finishing, even though it's not nice, but Penny has already been developed and is moving into production shortly, ensure we have a more than decent overlap between the two high-grade ore sources. And one of the attractions of working at a company with multiple operations is the ability to move around and gain a variety of experience for our technical team. And our staff at Vivian are already earmarked for other roles within the business. At Mount Magnet, Eridanus specifically, we're continuing the Stage 2 pit started last June, being a little deeper than 100 metres of the final 230 metre pit depth. This open pit will be the mainstay of feed at Mount Magnet for the next few years. And what's nice about this is the expectation of better grades at depth at Eridanus, which hopefully you can see on the section on the right. We do have a significant resource position on the Eridanus trend, which takes in the nearby Orion and Franks Towers areas, almost 1 million ounces. In order to provide important oxide feed to the mill, which does help optimise mill throughput, we have recently commenced the Orion pit just last quarter. The underground potential for Eridanus remains. We have completed a scoping study but have parked this for a period whilst we mine the pit deeper to better understand the geological background and establish drill positions closer to the pit base. Also at Mount Magnet, Galaxy's up and going. We actually mined the Galaxy open pits between 2012 and 2018. This is simply the collective name for the Saturn, Mars, Titan and Perseverance pits that were mined upon Ramelius's arrival in Mount Magnet. Due to the fact that we are in the banded iron formation here, we have excellent depth continuity of the geology. And this is supported by the historic Hill 50 mine coming up shortly. We're actually using the old Hill 50 decline for access, which requires rehabilitation only, and we are some 500 metres down that decline with surface infrastructure, power and water services already established since Project Go Ahead in March. We have a 5-year mine plan already, but don't be surprised if Galaxy goes longer. Recent drilling, see on the section, 6 metres at 6.8 strongly suggest the BIF extends well below the current mine plan. And even more interestingly, the 25 metres at 3.8 may well be the top of a breccia zone amenable to bulk mining. So to answer the question, where will your growth come from? Well, as it has in the past, it will come from both organic and inorganic sources. Here on our mining studies, processing studies slide, we're talking about organic growth that we achieve by announcing new resources following successful exploration, and then converting them into mines following completion of suitable mining studies. Each study moves at different rates depending on the priority to the business, as well as the availability of our internal teams who also support operations and do most of the study work as it turns out, meaning we only rely on consultants where absolutely necessary. We have made progress on the Hill 50 scoping study. You can see where Hill 50 sits in relation to Saturn and Mars, which constitute the Galaxy project. Geotechnical outcomes are encouraging, but we are talking about a deeper resource here, albeit at decent grades. And therefore, various haulage and refrigeration options have to be properly considered. Still at Mount Magnet, we're now at Bartus, which is in the same geological setting as Eridanus, that is, porphyries and ultramafics. On the right, we have a long section where the darker orange area is attempting to depict the higher grade underground potential, which we think is quite exciting at Bartus. The original Bartus pits had excellent grades at around 3.5 grams, but the granodiorite that we're currently drilling is blind to surface and therefore was not discovered in the early 2000s when the original pits were mined. We plan to do a fair bit more drilling here to produce an updated resource, noting that results are still to come in, including that from the deepest hole which has got visible gold, which is always nice to see. At Edna May, our work on the Stage 3 open pit is ongoing. Again, we have a large resource at our disposal, and we have further progressed some key sections of work, such as an updated resource model, and completed a new pit design using updated input parameters such as the diesel price. Our intent here is to seek pricing on this open pit from contracting and equipment leasing groups. This process is expected to be completed later this year, and a decision on the development status of the project will be taken thereafter. In terms of overall timing, development work must begin on Stage 3 in 2023 to meet the mine plan schedule we delivered last year, whereby meaningful production needs to hit the Edna May mill in FY26. At Rebecca, our most recent acquisition and our exploration GEO's new plaything, we have pumped in 18,500 metres since getting on the ground in February this year. We're only able to use around 9,000 metres of that in our new resource update due to the cut-off. Rebecca and its satellite deposits Duchess and Duke are now estimated to contain 31 million tonnes at 1.2 grams per tonne for 1.2 million ounces. We're only part way through the drill program, with the focus so far being more on infill rather than extensional. So we look forward to the completion of a wider program to test the full potential of the Rebecca package. In saying that, the new resource represents a modest 9% increase in the overall ounces, but importantly, almost 85% of those ounces are now in indicated, which I note has increased some 22% itself. So there is a high level of confidence in the integrity of the resource, and we continue to view the broader Rebecca project as underexplored and look forward to additional discoveries as our geological understanding grows. Speaking of returns, we have a track record of generating excellent returns from our M&A growth projects right back to the early days of the company. By project, we're showing purchase price in blue, cash generated in yellow, and net cash being the red dot. We have a nice trend established here with, I'll grant you, larger investments over time, but for larger and larger returns. Vivian, Edna May, Marda and Tampia are still in production, and we remain confident of generating returns consistent with that trend at our two newest projects, Penny and Rebecca. We have made 5 acquisitions in 5 years, and our balance sheet remains such that it allows us to consider opportunities as and when they arise. On the M&A front, as you can see from the previous net cash flow chart, we believe that any acquisition has to be accretive, but our focus is very much third hub, as opposed to smaller bolt-ons, which are not likely to move the dial for Ramelius, especially if they relate to Mount Magnet, which already has a substantial life, and are these days more treated like business as usual in our approach to their importance. In terms of what we are looking for, the chart would be familiar to most ASX gold followers, with the coloured bars representing the number of production centres. A third production centre would catapult Ramelius into the gap below the larger producers, where higher multiples are typically enjoyed. What about Rebecca, you may ask? Given the 3-year or so timeframe to production, then I would think about this more as a fourth hub possibility. So to summarise why we believe we're well placed going into FY23, firstly, we have a proven management team with a track record of delivery, managing a dynamic business, which consists of open pit, underground, processing and long-distance ore haulage operations. With our strong balance sheet and disciplined approach, we are well placed to strike the right balance between growth opportunities and shareholder returns based on a well-understood risk appetite. Thirdly, we are acquisitive by nature, and our track record of acquisition supports this. We're looking for the acquisition that sustainably pushes us past 300,000 ounces per annum production, and we believe that this growth aspiration will deliver superior returns for shareholders in the future, in line with our mission statement. We are committed to significant investment in exploration. We have a $25 million budget in FY23 and are very positive about the potential to add ounces, particularly at Mount Magnet and Rebecca. And finally, we have 2 important underground projects coming into production this year. And did I mention that our costs are expected to be lower in FY24 and 25 as a result? And as always, we'll keep the market updated as results come to hand. Thank you. I'm Mr. Slope.
Thanks, Mark. Any questions from the floor? No, I have one. So, Zeppi, in terms of the third production centre or sort of third material asset, is this very much or will continue to be an Australian-focused strategy, or do you contemplate offshore opportunities?
Very much a WA focus. I think it's our job to keep an eye, maybe one eye half open on what happens overseas. But really it's a watching brief. I think for us, we can add the most value by adding something in our backyard.
Thank you. Thanks very much.